No let up for banks. RBS Chief Stephen Hester says it's a miserable day after the bank agrees a fine of £400 million over LIBOR rigging. And it's not much better at HSBC. Boss Stuart Gulliver says the bank wasn't fit for purpose 2 years ago, but promises he's working on it. The expressions say it all. Richard Hunter, head of equities at Hargreaves Lansdown, joins me now from the London Stock Exchange. Richard, I just want to start with some of these comments from Gulliver. And the bank not fit for purpose 2 years ago. We've crushed our reputation with the Mexico events. But shock for investors.
Yes, they are. One does wonder, with the amount of announcements that have been made over the last couple of months for all the banks and various regulatory breaches, whether there is now at last an element of kitchen sinking. I mean, to put this into perspective, a lot of the scandals and mistakes that we've seen, be that LIBOR, PPI, interest rate swaps, or indeed Mexico, do tend to be ones that are sort of 3-4 years ago at the very minimum. And I think that the bank boards have finally realised that we need to, A, pay what we need to pay in terms of censures for making mistakes, but B, and equally importantly, explaining to the regulator and indeed investors that things are now totally different and that a new brush has been brought in.
Some of our guys at Breaking Views argue the banks are getting off too lightly. What do you think?
Well, if you take the amount of fines that they've had to provision for in the round over the last year or so, that's a moot point. I mean, the fact of the matter is, of course, they're in this strange situation where they're, in regulatory terms, they're being asked to put more money aside to improve their core Tier 1 ratios, let alone any expense involved with more regulatory requirements, set against which, of course, they're being encouraged to lend. So it's a difficult position for the banks to be in operationally, let alone the fact that they've got a number of legacy issues which really do need to be dealt with once and for all.
Let's talk investing in these banks. The index is down about 0.6 today. RBS and HSBC are both up. RBS has outperformed over the past 3 months. I think we're up about 18-19% year on year. What do you make of these as investments right now?
Well, I think the first thing you have to realise, of course, is that they're not the safe, immediate automatic entries into a portfolio which they were 5 or 6 years ago. I think you also need to feed into the mix that we're in a historically low interest rate environment, so you're probably going to be looking for banks which pay some sort of dividend, which of course immediately rules out RBS and Lloyds, let alone their government stakes. So then you're looking at something which has probably come through without government interference, perhaps Barclays, for example, with its universal banking model, although we'll hear more about that next week in its full year results. But generally speaking, in terms of the market consensus, with its 3.5% dividend yield and general strength and global stability, the favoured stock of the sector remains HSBC.
And when the market comes off, if this market comes off soon, do the banks come off as well?
They may well do, although a lot of what we've seen with the banks, of course, more recently has been stock-specific, and one would increasingly hope the more we hear about interest rate swaps, LIBOR, PPI and all the rest of it, that particular period of their history is at last coming to a close. One would hope so at the very least.
And just to finish up with, Richard, I know you couldn't possibly comment, but all this is pretty good news for Hargreaves Lansdown, isn't it? You're picking up a lot of their business.
There are certain pockets of their business where we do overlap, obviously in terms of their core business. As far as I'm aware, we've got no interest in moving into that space.
All right. Richard, thanks a lot. Good to see you. In Deal Zone today, it's John Malone versus Rupert Murdoch. Malone's Liberty Media set to take over pay TV operator Virgin Media for just under $16 billion. That's a 24% premium over yesterday's closing price. The move puts Malone on course for a direct clash with Murdoch's B Sky B. It could be a grudge match too, coming 10 years after Murdoch beat Malone for control of DirecTV, the largest US satellite broadcaster. That is all from us for now, but join Reuters every day at this time to take the pulse of the market. I'm Axel Threlfall. This is Reuters.